All right, today we're going to decode a really crucial economic signal that, honestly, a lot of investors miss, the PMI. We're going to dive into what the latest numbers are telling us about the economy's health, and more importantly, what it all might mean for your portfolio in this crazy market.
So let's just jump right into the big puzzle. You look around and you're seeing signs that the economy is slowing down, right? Manufacturing is weak, the job market's cooling off, but the markets are rallying. What is going on? It seems completely backward, but it all comes down to the very specific, kind of weird environment we're in right now.
You see, we're living in a bad news is good news world. For months, the biggest boogeyman for investors wasn't a slowing economy, it was the Federal Reserve aggressively hiking interest rates. So now, any piece of data that shows the economy is cooling off is seen as a huge green light for the Fed to take its foot off the gas, which is exactly what the market wants to see.
Now, to really get this, we need to know our key metric, the PMI, or the Purchasing Managers Index. Just think of it like a survey of businesses that gives us a real-time pulse on how the economy is doing. And it's super simple. If the number is over 50, that sector is growing. If it's below 50, it's shrinking. That number, 50, is the magic line in the sand.
And the latest manufacturing PMI number? It came in at 49.1. Yep, that's below that critical 50-point line, putting it officially in contraction territory. And listen, this isn't just a blip. This is the 7th straight month that manufacturing has been shrinking. But as always, that headline number doesn't tell the whole story.
When you actually dig into the details, the picture gets a lot messier. I mean, look at this. Production actually bounced back into expansion territory. But at the same time, new orders fell again, and the employment part of the index is deep in contraction. So what do you make of this mixed bag? Well, the key takeaway seems to be that the sector is kind of stagnant, treading water, not in a complete nosedive.
And this brings us right back to our bad news is good news theme. This report was, for the market, literally perfect. It was just weak enough to give the Federal Reserve a reason to stay dovish, to keep its foot off the brakes, but not so weak that it starts screaming that a major recession is right around the corner. It's the absolute sweet spot for investors right now. But look, manufacturing is only one part of the story. The U.S. economy, it is overwhelmingly driven by the services sector. Think healthcare, tech, hospitality, all of that. And that makes the upcoming services PMI report the single most important number the market is waiting for. Seriously.
This one report could either pour gasoline on the current market rally or just stop it dead in its tracks. It really presents us with two very different possible futures for the economy. So let's break down what those two paths look like, starting with the one everyone's hoping for.
Okay, this is the bull case. It's the scenario the market is betting on right now. It's what we call the Goldilocks path, where everything comes in not too hot, not too cold, but, you guessed it, just right. So here's how that would play out. First, the services PMI lands right around what everyone expects, showing some moderate growth. This tells us the economy is cooling down, but in a really controlled way, avoiding a full-blown recession. This gives the Fed the perfect cover to keep easing up on policy, which in turn just fuels a classic risk-on rally across stocks, crypto, the whole shebang.
But what if things aren't just right? Well, there are two potential traps that could spring on the market, and either one would lead to a much more pessimistic or bearish outcome.
This lays out the two big risks pretty clearly. On the one hand, the services PMI could come in way too strong, causing prices to start heating up again. That would totally challenge the Fed's dovish plan and probably cause bond yields and the dollar to spike while stocks sell off. But on the other hand, what if the report comes in too weak, below 50? Well, that could be a huge red flag that the economy is actually cracking, sending recession odds way up and likely triggering a mad dash for safety.
So, knowing these potential paths, how does this all translate into an actual investment strategy? Let's walk through the playbook, which is based on what's seen as the most likely outcome.
So the core thesis, the main bet here, is that we will in fact get that Goldilocks slowdown. The analysis suggests the base case is for moderating growth in the services sector, which will keep the Fed happy and continue to support riskier assets. This one assumption underpins the entire strategy we're about to go through. So what does this mean for stocks? The call is to be overweight, meaning you'd want to have more exposure than usual. A dovish Fed is like a powerful tailwind, especially for growth stocks in the NASDAQ and small-cap stocks in the Russell 2000. The strategy also points to rotating into sectors that are really sensitive to interest rates, like financials, utilities, and healthcare.
The outlook for bonds is also overweight. The thinking here is that concerns about slowing growth will keep a lid on long-term treasury yields, or even push them lower. This could lead to something called a bull steepener. which is basically when the Fed cuts short-term rates while long-term rates fall a bit more slowly. It's a dynamic that's generally seen as a pretty positive signal for the economy.
Now, commodities, that's a much more mixed bag. The clear standout here is gold, with a bullish outlook. Why? Well, it's seen as a great hedge against policy changes, tends to do well when interest rates are falling and the US dollar is weaker. On the complete other end of the spectrum, you have industrial metals, which have a bearish outlook because their demand is tied directly to that sluggish global manufacturing we talked about earlier.
And finally, let's look at a few other assets where this theme continues. The US dollar is expected to weaken as the Fed eases up. That improved liquidity and appetite for risk is seen as a big positive for assets like Bitcoin and Ethereum. And of course, lower borrowing costs would be a direct tailwind for interest rate-sensitive sectors, and there's almost nothing more sensitive to rates than real estate. So, here's the bottom line. The market is positioned for a perfect Goldilocks soft landing. It's betting that the Fed can navigate this whole thing flawlessly. And that leaves all of us with one final critical question to think about. In all its optimism, has the market completely priced out the very real risk that things don't go exactly according to plan? That's the key question for every investor right now. Thanks for joining this explainer.